Are owner distributions, or what's also referred to as owner draws, are taxable? A lot of business owners think, hey, when I take money out from my business, do I pay tax on those distributions regardless of what entity I'm at? So in this video, I'm gonna break down that myth for you, and I'm gonna break down exactly what you need to know about owner distributions, what is taxable, what is not taxable, and how to use it as a tax strategy instead. Ready? Let's go. Hey, welcome to my whiteboard tax strategy. My name is Boris Musheyev. I'm a CPA and a certified tax strategist. Every Tuesday, I release a tax strategy video here on YouTube for you, the business owner. By watching this video, my goal is for you to start paying less in taxes right away. So go ahead, subscribe to my channel, like it, share it, and even comment below. I appreciate you. Now let's get started. Cool, let's get started. So I've broken down for you in three simple steps, as always, right? So first of all, we're gonna define what is really owner distributions for different types of entities, right? We've got sole proprietorship, partnerships, C corporations, and S corporations. Then we're gonna talk about a tax strategy, what to do and what not to do with your bank account, owner distribution, and so forth. And then we're going to talk about Henry. I've wrote out a nice example for you so I can explain to you what do you pay tax on, what do you not pay tax on, and what really not to do and follow this strategy. So let's kind of talk about owner distribution defined. Now there's four types of main entities that you as a small business owner are probably part of, right? There's a sole proprietorship, partnership, C corporation, and an S corporation. A sole proprietorship is when you start your business from scratch under your own name or just have a DBA. You have a separate bank account. I hope you have a separate bank account, okay? You have a separate bank account and all the money goes in, you spend it for expenses, and then what happens is that you take the money out as an owner draw. It's your money, it's your business account, you go in and you take the money out. That is considered owner's draws. That's kind of a simple term for sole proprietorships. Then we have partnerships, very, very similar to sole proprietorships. By the way, going back over here, sole proprietorships could also be single member LLC. If you have an LLC and you're the only owner, which you didn't make an election to be treated as an S or a C corporation, well, for tax purposes, you're considered a sole proprietorship, and you feel free, you can dip into your business bank account and take the money out without paying any income tax on it, okay? Because you pay tax on the profit, and I'm gonna talk about it in the strategy. Kind of same thing with the partnerships. Whatever agreement that you have with your partner, you pay yourselves out on the guaranteed payments. Whatever money is left over, you take it as partner distributions. C corporations are a little bit different on the other hand. C corporations, you've got what's called a double taxation. C corporation pays taxes on its profits, but at the same time, they have what's called the dividend distributions. Think about owning an Apple stock, right? When you own an Apple stock gives you dividends. That is dividend distribution. You pay tax on that again. So far we've covered owner draw, partner distributions, C corporation, dividend distribution, and the most important one, S corporation, which is what most small business owners elect to be taxed at as an S corporation, and they have what's called a shareholder distribution. The question is, do you pay taxes on the shareholder distribution in an S corporation compared to a C corporation? Short answer is no, but we're gonna dive deep into it in a tax strategy. Now that we have defined what are different types of owner distributions, we're gonna move on to a tax strategy. But one thing I want you to remember, throughout this video, I'm gonna be referring to all of these distributions as just owner distributions. It doesn't matter the fact that they have different definitions in different entities. The fact of the matter is it's one word that we're going to be using, but it does have different tax implications in different entities. So we're going to talk about that in a tax strategy and an example right after this break. Hey, Boris Musheyev here. Sorry for the quick interruption. 5 seconds, I promise. I want to make sure you get your free PDF, 7 write-offs every S corporation business owner must know. The link to this free PDF is in the description below. That's it. Thank you so much. Continue watching. Okay, cool. Now let's talk about a tax strategy. First of all, when you are setting up your new business, whether it's your first business, your second business, or if you already have an existing business, whether it's making hundreds of thousands of dollars or millions of dollars, what you want to make sure is that you avoid double taxation. Now, when does double taxation really kick in? Is when you have a C corporation, because C corporation, you pay taxes on the profits, but at the same time, you pay taxes on owner distributions. Like we said, dividend distributions. So number one thing you want to do is avoid double taxation. Now, you might have a C corporation for a reason. There's a purpose to it, whatever that may be. But if you are, well, not if you are, if you only have an accountant that you speak to once a year, believe me, you're most likely overpaying in taxes. I just spoke to a C corporation owner, makes about $3 million in gross revenue and profits a little bit less than $1 million. He's paying taxes because he pays double taxes, because he pays taxes on the profits, but also on the owner draw. So you want to make sure you always speak to your tax advisor and reevaluate your entity every year. So avoid double taxation. Most small businesses do not need to be C corporation. C corporation was designed for businesses that have more than 100 shareholders. You are a small business owner, so you most likely want to be an S corporation. But even an S corporation, you may end up paying taxes on your distribution. And there's going to be a link on the video right now, somewhere popping up right now, how to avoid those taxes on S corporation. We're not going to cover it in this video in detail, but there may be situations like that. Now, determine which is the best business entity type for you. Like I said, there's 3 types. Sole proprietorship partnerships, if you have a partner, okay? And C corporations and S corporations. C corporations is not always the best. Now you've got to determine which one of these is good for you. Now, assuming you do not have a partner, do you need to be a sole proprietor, which is a single member LLC, or an S corporation? In most cases, if you're profiting more than $80,000 in your business, you might want to be an S corporation, because S corporation avoids paying self-employment taxes on all the profits, but at the same time, the shareholder distributions are not taxable compared to C corporation dividend distributions. So determine which business entity type you need to be. Speak to your tax advisor. If you do not have a tax advisor and you have a profitable business, ladies and gentlemen, I'm telling you right now, you're freaking overpaying in taxes, okay? That's the truth. That's the fact. Now, do not do what most accountants tell their clients to do. Zero out your bank account at the end of the year. Make sure there's $0 left in your bank account. Take everything out. What a nonsense advice. Don't worry about it, because as a business owner, you do not pay taxes on what's left in the business. We're going to talk about an example right now. Unless you're a C corporation, right? Unless you are a C corporation, most of the small business owners are not a C corporation. So they do not pay any taxes on the money that's left over in the bank account, and there's no double taxation. You pay taxes on the profit. So that means you can take as much distributions out from your business as you want. So do not zero out your bank account. It's pointless. It's nonsense. The most important thing is do not overdraw. What do I mean by that? Like, well, Boris, how can I overdraw? Isn't my bank going to penalize me for it? Let's say you only made $10,000 in profit. So you only have $10,000 cash in the business. But you also took out a $100,000 loan. So now you have $110,000 sitting in the bank account as cash. You're like, you know what? I'm going to take the entire $110,000 out. No, there are consequences. And that is called overdrawing against your distributions or against your, business assets, so to speak, whatever you want to call it. But that is basically an excess distribution. You took out more money than the business could allow you. In that case, you will be paying a tax on it. There's going to be a video in the description and somewhere around this video that you can watch how exactly that works. Now let's talk about Henry, and I'll give you an example about Henry. I'll walk you through this tax strategy, everything that we've discussed right after this break. Hey, thank you so much for watching the video. Very quickly, if you don't mind, I want to ask for your help. I need your help. I want other business owners just like you that will benefit from a video like this to catch this video. The best thing that you can do for me, please either like the video or even say something in the comments, because that really helps the YouTube algorithm when it sees a lot of engagement to push the video to other to other business owners just like yourself, or better yet, subscribe to the channel. Would be much appreciated. Thank you again. Now let's get back to the tax. All right, welcome back. Let's talk about Henry. So I'm going to walk you through this example so we can, first of all, everything that we've defined is going to be here, and the tax strategy that I spoke to you about is going to be in this example. Now, Henry makes a gross revenue of $1.5 million, okay? His expenses are $700,000, and he also took an owner's salary of $200,000. Now look, if you are an entity such as an S corporation or even a C corporation, you have to pay yourself a salary. So in this case, his net profit is $600,000. Let's assume, okay, that in our example, Henry is an S corporation. You can also assume that he's a sole proprietor, but as a sole proprietor, he wouldn't have a salary. But for the purposes of this example of focusing on net profit, right, $600,000. Let's say this money, the entire $600,000 is in your bank account. A lot of times I get asked the question, how much can I take out on distributions? Can I take it out all in one shot? Right? And how much do I pay tax on it? The answer is zero, right? You pay tax on the net profit. You don't pay tax on your distributions. So if you took out $250,000 out of the 600 from your bank, transferred it to your personal, you're not going to pay tax on $250,000. What's left in the bank is $350,000. You're not going to pay tax on $350,000 either. You're going to pay tax on what you profited, what the business made. Let's say next year you want to take out the $350,000 that was left in the bank. That's no problem at all. You're not going to pay the tax on it because you've already paid it in its first year. And that's exactly Henry's situation. Henry has a net profit of $600,000. At the end of the year, he's going to pay tax on a $600,000, regardless of how much money he took out as owner distributions, regardless how much money was left in the bank account, and you do not need to zero out your bank account. Just not how the mathematics work on this thing, okay? And what's really, really important is that when you have really high net profits, or even low net profits, whatever that may be, you want to make sure you work with a tax advisor and pay your estimated quarterly tax payments. Why is that so important? Now, some business owners don't want to pay estimated quarterly payments because they use the money for something else. They're like, you know what? I'm okay paying penalty. Okay, that's a small percentage of business owners. Majority percentage of business owners absolutely hate it when they have to pay a chunk sum of money at the end of the year with taxes. And if you are that individual or business owner, I urge you, open your tax return and you will see somewhere on the bottom of your tax return, which your accountant probably didn't point out, there is an underpayment penalty for not paying your quarterly estimated tax payments. Now, not only now that you pay a big chunk of money at the end of the year, you also have to pay underpayment penalty. So be cautious of that as well. I hope this was helpful, and till the next time.